The accounting equation. The accounting equation is very important for a business to be able to record their transactions. So transactions are things that affect the company's finances in terms of buying and selling things, purchasing business, land, equipment, any of those large assets, even purchasing supplies, paying expenses and invoices, having an owner invest in or withdraw money from the business, receiving revenue for products or services, collecting accounts receivable, paying accounts payable, anything that touches an asset, liability, or equity component of the company is a business transaction. So this is the formula for the accounting equation. This is one of the most important things that you will learn not only in this class, just for this class, but also the rest of the accounting courses that you take within the curriculum. So assets equal liabilities plus equity. This is something that you'll need to memorize. We will use it essentially for every transaction that takes place. Remember, assets are the resources of the company, liabilities are the debts, and owner's equity is the owner's claim on the assets. Here's the accounting equation again, broken down into our three categories, of course, but then with individual accounts that are listed as each of these types of categories. We talked about these in the previous video, so I just wanted you to see how they actually relate to the accounting equation. This is the image that was in the previous video when we were talking about each individual account is represented here by a file folder. Now you can see how they are affected within the accounting equation. This shows a similar illustration but broken down a little bit more, just any way to help you understand. Assets and liability accounts, these are fairly straightforward. The equity accounts, they have their own calculation within the equity accounts. So equity, first of all, has to do with owner transactions. So common stock would be an owner investment. Dividends are basically the same thing as owner withdrawals. So anytime the owner or owners put money into the business, that increases equity. Anytime money is distributed out to owner or owners, that decreases equity. So that's the owner portion of how equity is calculated. The next part has to do with the revenues and expenses of the business. And so taken together, revenues minus expenses, this has to do with net income. And that's actually the formula, the basic formula for net income is revenues minus expenses. Revenues increase equity and expenses decrease equity. When we record transactions, we record them using double entry accounting. There are two rules to double entry accounting. They affect, or they are rules governing how we use the accounting equation to record transactions. So remember, the accounting equation is assets equal liabilities plus equity. So when we're looking at the accounting equation, we can take those two rules and apply them here. So the first rule is the effect of every transaction is an increase or a decrease in one or more of the accounting equation elements. So for instance, if assets increase, then something else on the other side will have to increase. the two sides, and this is the second rule, the two sides of the accounting equation are always equal.